What's more, Aon has also done in its survey across several companies and industries, 1,500 companies across 40 sectors, has discovered that attrition is at a record high. We've been talking about that on the channel. Aon is saying it is at a record high of 21%. That's a level we've not seen in at least a decade. To talk to us more about this, joining us is Aon India's partner, Roopank Chaudhary. Roopank, it's always a pleasure talking to you. Thank you so much. So 9.9% average increment is what you folks are projecting against the backdrop of a record high inflation. I'm not just asking this as a salaried employee, but if you've got attrition at a record high, surely your salary increments should also be at a record high.
Yes, and the thing is that they are at a record high. I think we were expecting salary increases to go back to the pre-pandemic level of 2019 when it was 9.3%, but 9.9% is a big jump. I think, as you rightly said, the last time we had seen such high increases was 2016, when we had looked at around about 10.1%. After that, it's been hovering around 9.3, 9.4. So the fact that it's gone back, to almost double digits, almost close to 10%, is a very strong message. That not only is this driven by the fact that there is some bit of correction that has happened the last 2 years. 2020 was a bad year. It was a difficult year for employees, right? 2021, things improved a little bit. So some of it is a correction of the last 2 years, but a lot of it has to do with the fact that the fundamentals of the economy are strong. The growth is back. The recovery is strong. And we are seeing this growth in every sector. And as a result, salary increases across all sectors, not only to a few. And yes, you can't ignore the fact that a lot of this is being driven by the new age companies. So e-commerce companies, startups, IT companies, their increments are in high double digit. So that's also leading to a very, very strong impact on the overall numbers.
So Roopank, let's get down to specifics, right? So when we talk about these new age companies, the tech companies, the startups, which are of course, backed by serious capital now, they've been one of the biggest beneficiaries of the easy money era as well, right? Since the outbreak of COVID-19. How fat will the paychecks get? How much fatter will the paychecks get? What kind of increments? What do you mean by high double digits?
So we're talking about, when you're talking about an India average of 9.9% projected, the increments for these startup companies, which include, sorry, not startup, but new age companies, which include startups, include e-commerce companies and tech companies, is 12.9%. So almost 3% higher than the India average. So that is the kind of increments on an average that new age companies can expect. Now, there is a little bit more flavor to this, right? If you add to the fact that for the top performers in these companies, the multiplier is actually higher than what is for India Inc. So 1.8x. So a top rater in a new age company can get 1.8 times of a number of 12.9, so which itself translates into a much higher number. So 3% above the India average is what an average employee can get in the new age company. But if you're a top rater, it can get even double of that.
And would this be excluding perks that startups have been found to be giving, whether, it is super bikes, whether it is pet insurance, cars, fancy gadgets?
Yes. So see, those are more ad hoc and are more discretionary, which are given by certain companies. You really can't call that as a norm, and it's not that companies are not giving it. But when we track our compensation numbers, we are talking about what's measurable in clearly fixed pay. So when we are talking about a 12.9% average increase for the new age companies, we are talking purely about fixed pay. We're not including any variable pay or bonus. We're not including any stock, and we're not including any perks or benefits which get added on top of this. This is purely the fixed salary.
It's very important to note that the near 13% salary hike for startups is minus ESOPs. That's the stock options, is minus all kind of perks that we keep reading about and hearing about. Now, Roopank, I think, it's become very clear the engineer is king. There is a global talent crunch. You even have the likes of Elon Musk tweeting about it, right? Just to attract the high talent. How are you seeing the mid-tier IT companies, the large IT companies, who are very particular about their balance sheets as well, compete with with new age tech companies that are backed by, like I said, venture capital and have been the biggest beneficiaries of easy money?
So, we see a bit of a divide when it comes to the maturity levels of these new age companies. So when a lot of these new age companies are e-commerce companies, startups, and the more agile and the more fast-growing IT tech companies, right? When you look at the more older world tech companies, it's not that they're not giving increments either, right? I think if you look at the kind of tech company increments that we are seeing for this year, it's by no imagination any low. High-tech IT companies are talking about 11.5% increase going forward. So I would say that some of these mid-tier companies are also giving out higher hikes at 11-12%, not as high as the new age companies, but still high enough, higher than the India average of 9.9%. So that's one. They are also in that bandwagon to make sure that they're not losing talent. I think they are being a little bit more sustained and a little bit more focused on the more higher order things, right? I think in addition to giving a robust salary increase in the 11.5% range, I think they're also trying to focus on their tier one talent and their critical talent. I think attrition is extremely high in this sector at 23-24%. But what they're trying to do is that they're trying to retain the top 10-15% of their employees by giving them more money, by giving them mid-cycle increases, off-cycle increases, by giving them possibly more long-term incentive and more perks, and also trying to create a stronger environment for growth. So I would say that the biggest difference is that the ones that are backed by venture firms and have a lot of capital on hand are able to dole out much higher increments and joining bonuses and cash. Whereas the mid-tier segment companies are giving increments as well, which is high at 11%, but are also looking at other factors to try and retain or ring-fence talent. Otherwise, a war for talent actually becomes impossible to win.
That's right. The war of talent that we're seeing is just not in India. It has become a global phenomenon, hasn't it, Roopank? Now, what is also a global phenomenon is inflation. So when we've got high inflation, which is at a 40-year high in the US, and what we've seen even in India, inflation going up, the salary hike of 9.9% average suddenly doesn't sound very impressive because it's barely beating inflation.
Well, yes. And, we also believe that when you look at, inflation, I think there are pressures, there are concerns, and, that's something which could dampen the sentiment a little bit. Having said that, if you compare India versus the rest of the economies around, the real rate of increase, which is the inflation-adjusted increase, is still amongst the highest. If you take inflation to be around about 4.95%, I'm talking about an IMF estimate out here. At 9.9%, the real rate of increase is still 5%, which is not bad. The closest one to India is China. China, the expected salary increase is 6%, inflation is close to 1.8%, real rate comes to around about 4.2%. But if you look at the US, salary increase projection of 3.6, inflation of 3.5, you have a 0.1% real rate of increase, right? If you look at Brazil, in Brazil, the inflation is 5.3% and the increment rate is 5%. So you're absolutely right that inflation is also fairly high and the pressures continue to be strong. But we think that at 9.9%, the employee has a decent enough real rate to go back home as compared to in some of the previous years when we have seen this real rate of inflation fall to 2.5%, 3%. At 5%, it's still not bad, and it's much better than the rest of the economies around us.
Okay, so we're doing better than other economies. It's not great. Barely manages to beat inflation, but you're saying that India is better off than many other countries. I take that point, Roopank. Now, what about? Are you seeing any change in trends given the fact you've got inflation, given the fact you've got record high attrition? Are employers doing more to retain better talent? Are higher performers getting better pay, more perks? Any insights there?
Yeah, so, I think, it's clear to say that the war for talent or attrition is going to continue for a fairly long time. It's not a flash in the pan. It's not something that we can expect to get over in a year or two, because end of the day, the demand for tech skills, digital skills, is more than the supply. There is a supply-demand mismatch, and that will remain for some time. I think there are two ways to look at this. In the short run, companies will pay out more increases to them. In the longer run, I think it's a build versus buy phenomenon, and companies have to start building this talent internally, because otherwise they will be fighting the same war for talent in the next 2-3 years. But having said that, I think what one needs to keep in mind is that if you look at performance differentiation is much stronger or much higher than new age companies. I had made a mention of the multiplier. So while the multiplier for India Inc. is 1.7x, which means a top rater in India overall can get a 1.7 times multiplier to an average increase. New age companies, this is 2x. So they can actually get twice the amount of increase that an average employee is getting. Also, don't forget that there are more people who are rated below expectation and are asked to go in new age companies, because the tolerance for low performance is also lesser. So it's a hire and fire policy that remains as well. You are paid well, but if you don't do well, you don't have that much leeway to stay in the company as well. And I think more importantly, as the impact on bottom line goes up and the impact on balance sheet is becoming critical, I think there are other areas of retention which new age companies are resorting to. I think if you were to look at the kind of things which came up in our survey, recognition for their top employees is a number one area for new age companies to retain employees. Accessibility to leadership, how much they're able to see their CEOs, CXOs and talk to them is also very important. How fairly they are treated when it comes to rewards internally is important. And then finally, the manager capability or managerial empathy to work with employees in a remote location or a hybrid location is also very, very important. Those are some of the areas outside of rewards which companies are trying to bring in to retain employees and ensure that the war for talent is also won by areas beyond compensation.
Okay, so that's some of the trends that we're seeing. And in the old age economies, you talked about the differentiator. Is meritocracy getting paid more?
Absolutely. What we are
premium?
seeing in yes. So as I mentioned, you can assume that if you are a top rater and key talent, you can expect at least a 1.9 to a 2x multiple. So if I am an average rater in one of these older companies and I have an increment of 10%, top rater, I can easily get as high as 20%. In some cases, it's going as high as even as 23%. So the differentiation is becoming very, very strong. You may have a slightly lower budget than new age companies, but that budget is being distributed disproportionately towards the top talent. What we'd also seen is that in 2020, companies were lenient. They were giving higher ratings because the lack of performance was not because of employees. It was a pandemic which led to a crisis. In 21, companies are looking at good overall business performance. As a result, they're also differentiating much more than 2020.
Okay, so that's as far as meritocracy getting a fat premium goes. My final question for you, Roopank, for 2022, while there will be attrition, while there will be inflation, there's also a lot of uncertainty. There will be rate hikes by the US Fed back home. The era of easy money will go away. We've seen what's happened with the new age company IPOs in India too, from a Paytm to a Zomato to a Nykaa, all of that. Won't that also impact pay and salary hikes?
Our opinion is possibly not. I think what we have seen is that even if you take what's happening in the markets or what's happening global inflation and political uncertainty is definitely something which could be a headwind, right? And it may play a spoilsport in some areas. But what we have seen is that, any black swan event, what happened with COVID or with the second wave, even Omicron, and how companies were able to mitigate that and show resilience to bounce back on business overall outlook and performance will remain. Our sense is that overall business sentiment will not really get impacted or suffer so much. As long as that is the case, I think the ability of tech companies to look at that increments and the demand for digital talent is not really going to go away. It might get impacted to a lesser extent, but overall we expect companies to be able to weather such uncertainty and storms, because the overall fundamentals of these companies are strong and fairly long-term, and hence the robustness of the optimism remains intact.
Okay, so that's some of the trends that are expected for 2022. So average hike of 9.9%, the highest since 2016, even as attrition is a record high of 21%, barely managing to beat inflation, but still doing better than the rest of the world. Startups and new age companies offering much higher increments maybe in 2022, maybe just 13% minus ESOPs and other rewards. Thanks so much, Roopank.
Thank you. Thank you so much, Nayantara.